If you've just received an inheritance, there's 5 important steps to consider. The first step is to make sure you don't make any quick decisions with your money. If, for example, you use those proceeds to purchase an investment property, then it's likely you could incur stamp duty. And if you later find out that that was a bad investment decision, there'll be extra costs to unwind that. Next, you need to consider what type of asset you've received, because they each have different taxation effects depending on whether they're an estate asset, superannuation, life insurance, or a primary residence of the deceased. Next, you need to consider what your goals are. If you have short-term goals, it may be best to park the money in cash rather than be exposed to volatility of investment markets, given that you're planning to access those funds in the short term. However, if your goals are longer term, it may be better to invest those money. Next, you need to consider the different after-tax rates of return of how you can invest your money. For instance, if you have credit card debt or personal loans, then it may be best to pay off those because they will incur a higher cost than most investment options can potentially produce. And lastly, if you've received a significant amount of money, it may have changed your wider financial planning. You may not need life insurances anymore. You may need to set up a family trust. You may need different legal documents such as a binding financial agreement or to update your estate planning. So when you receive an inheritance, it's always good to stop and think about how to best utilize those proceeds. And if you need help with that, please reach out.